Investor believe a stock rises only when profit rises. If earning grow, price go up. If earning fall, price go down. Sounds logical, but market are more complex than that. Sometimes a company's profit grows only modestly, yet the stock doubles. Sometimes earning barely change, yet price runs sharply upward. How is that possible? Because stock prices move not only on earning but also on valuation. When the market decide to pay a higher valuation multiple, it is called re-rating. This is one of the most powerful concepts behind multibaggers. Let's start with the foundation. Stock price is broadly driven by two engines, earnings and the multiple investors are willing to pay for those earnings. That multiple may be PE, EV EBITDA, price to book, or another metric depending on the business. Imagine a company earns rupees 10 per share. If the market value it at PE 10, stock price became rupees 100. Now earning remain rupees 10, but the market became more optimistic and valued it at PE 20. Price became 200. Same earnings, double price. That is re-rating. Why would the market suddenly pay more? First, business quality improves. Margin rises, return on capital improves, growth became more consistent. Cash flow strengthens, balance sheet becomes cleaner. Second, management credibility improves. Company with weak reputation starts delivering quarter after quarter. Trust rises. Third, industry outlook improves. A neglected sector became attractive due to policy changes, demand recovery, capacity tightening, or structural growth. Four, risk falls. Debt reduces, governance improves, litigation risk disappears, volatility declines. Fifth, growth visibility increases. The market start believing the company has a longer runway than previously assumed. When confidence improves, valuation often improves before earning fully catch up. That is why many big winners move early. Let's make this practical. Suppose a company was seen as a cyclical and unreliable. It traded cheaply for years. Then it improves operation, strengthens margin, win market share, and shows consistency. Investors stop treating it like a low quality and start valuing it like a stronger business. That change in perception alone can create huge returns. Important warning, re rating is powerful but not endless. Once a stock becomes expensive, future returns depend more on actual earning growth. If business execution slows, re rating can stop. If expectations become unrealistic, de rating can begin. This is why buying after a huge run without understanding valuation can be dangerous, very, very dangerous. What should smart investor watch for? Important. Improving margins, debt reduction, better cash flow, higher ROCE or ROE, return on capital employed or return on equity, management consistency, sector recovery, new products, stronger guidance. These are common signs that a business may be moving from ignored to respected. But remember, not every cheap stock get derated. Some remain cheap because problems are real. Re-rating needs genuine improvement, not social media excitement. Here is the biggest takeaway. Stock do not rise only because profit rises. They also rise because market changes how it value those profit. When earnings growth and re-rating happen, returns can become extraordinary. That is how many multibaggers are created. Make sure you subscribe the channel and like the video. Thank you very much. See you in the next video.